So here to help us weigh up the chances of a double dip, we're joined by Jefferies International's chief European financial economist, David Owen. David, thank you so much for coming in to speak to us. So the debate right now seems to be centred on whether governments in Europe and the US can cut their debt, reduce their budget deficits without strangling economic growth.
Yes, I think certainly for the Eurozone, the issue is there's not much in the way of domestic demand, and I think most of the recovery we've seen to date is all about inventories, and those sorts of recoveries don't really last for very long. Yes, the Euro's gone down, but it hasn't in a historic sense really fallen that far, and there are long lags involved. So I'm actually very concerned that as we go into the second half of this year, the Eurozone will see increasing signs of weakness. The UK probably has enough momentum to see us through. VAT in particular as well will bring forward spending into the fourth quarter.
So a potential double dip on the cards for Europe.
Yes.
And one of the main concerns amongst investors right now seems to be that policymakers may be repeating the mistakes that we saw in the 1930s by cutting back too far, too fast.
That's certainly true of some countries. I mean, the profitable economies inside the Eurosystem, including, of course, Spain, Greece, Portugal, Ireland, they're in recession and will remain in a recession for quite some time. For the UK, I think we've got momentum to actually see us through, and for the US, they're really not doing anything on the fiscal side. So we still see the US growing, not strongly, but the US should still see reasonable growth.
An interesting European Central Bank President Jean-Claude Trichet saying that a double dip is not on the cards, that European governments are doing exactly the right thing by implementing austerity measures.
Well, that's not what his forecast actually suggests. If you look at the last set of forecasts the ECB actually produced, they actually attached quite a high probability to the Eurozone being actual recession next year. It wasn't their central case, of course, but they did revise down their growth forecast for next year to only around 1%. And they saw a high probability that the figure next year is actually negative.
And interestingly, you've alluded to this, the consensus right now seems to be that across the Atlantic in the US we're going to see an economic slowdown as opposed to a double dip.
Yes, I think, the US is slowing. The non-farm payroll figures on Friday were bang in line with our expectations. I mean, at the moment we're in this period where a lot of the boost from the inventory cycle is beginning to play off, and there are obviously some signs of a slowdown more globally. But the US, isn't tightening in the way we're doing inside Europe. It's a very different thing altogether.
So what is that going to mean for them further down the line? They're
going to have to tighten, and at some point maybe the markets will actually switch focus and look at the US fiscal position. But at the moment it's all about Europe, and it's all about the fiscal position here and the sovereign debt problems.
It's interesting because unemployment is still a big challenge for the US economy. As you say, it's private sector hiring that is very much the focus, a test of the health of the economy right now. Those figures came in less than expected. Many analysts are saying that, as you say, we won't see a double dip scenario, but I mean, these issues are going to be ongoing, aren't they? The unemployment, weak consumer spending, and indeed government spending as well. I mean,
we've come through a monumental banking crisis, so you never would expect domestic demand to be particularly strong over the next few years. In fact, it takes 5, 6, maybe 7 years before bank lending actually resumes, really. The other thing to highlight is that unless you have really strong growth, above trend growth, systematically, you don't tend to have unemployment falling. So the unemployment rate inside Europe is going to be stuck at very high levels, inside the Eurozone stuck above 10% probably for quite a considerable period of time. So unemployment's here to stay. And for countries like Spain, it's a huge problem.
OK, David, thank you so much for coming in to speak to us. David Owen, Chief European Financial Economist for Jefferies International.